Hi, good morning. Thank you once again for coming online. Today, we will be covering the entire syllabus, and hopefully, we will have time to cover the entire thing within the couple of hours that we have. So last week, we went on to derivatives. We did options the week before. Then last week, we covered forwards and futures, right? The forward rate agreement and futures. So continuing from last week, we have to cover swaps. Right, so I will explain what happens in a swap. Now, what happens is, if interest rates are going up, right, if interest rates are going up, and if you have taken a housing loan, will you prefer to pay if interest rates are going up and you have taken a housing loan, will you prefer to pay a floating rate or a fixed rate? What do you all think? You prefer to pay a floating rate or fixed rate when interest rates have gone up, are going up? Yeah, very good. When interest rates are going up, you'll prefer to pay a fixed rate. Now, let's assume you have taken a floating rate loan, right? So this is you. And you're paying PLR to the bank. All of a sudden, you find interest rates are going up. Now, you will prefer to switch from a floating rate onto a fixed rate. Right? So how can you do that? What you can do is, you can approach a bank which offers swaps, or any counterparty which offers a swap, right? So let's call it swap bank. And you will go and tell them that you want to switch your loan from a floating rate to a fixed rate. Now, the other thing is, let's assume that your amount is 10 million rupees. Right? You have borrowed 10 million rupees. This is your original loan. Now, what this swap bank will tell you is that on 10 million rupees, they will ask you to pay a rate of 12%. So, one thing is, let's assume you are borrowing a PLR plus 2%. PLR plus 2%. And that's the original loan is PLR plus 2%. So, the swap bank will tell you to pay them a rate of 12%, and in turn, they will pay you PLR on 10 million. So your original loan is going at PLR plus 2%. The amount is 10 million. And the swap arrangement is that the bank will tell you to pay then 12% fixed, and the bank will pay you PLR on 10 million. Right? So if you look at the net payments, now PLR plus 2 on 10 million, you are paying. So let's say payments are denoted by a negative sign because there is cash outflows. Then you are receiving PLR on 10 million. And you are paying 12%. Again on 10 million. So this is the net cash flow. Now, see the 10 million is common. Right. So you end up with PLR plus 2%. This is a negative thing. Plus PLR minus 12%. That is your net PLR. So this is actually a negative sign. So let's put it as negative. You're paying. It is minus PLR minus 2% plus PLR minus 12%. Right? So PLR cancels off. Plus and minus cancels off. You are left with 10 million into 14% negative. Right. So now originally you were paying PLR plus 2% on 10 million, but now you end up paying a net of 14% on the 10 million. Right. So this was a floating rate. Originally you had borrowed on a floating basis. Now you are going on a fixed rate. So you have switched from paying a floating rate to paying a fixed rate. That's called an interest rate swap. This is the interest rate swap. That is called an interest rate swap. That is where you switch from paying a floating rate to paying a fixed rate. So you end up paying a fixed rate of 14%. And that's called a swap. And you can do the opposite also. Now, when will you prefer to pay a floating rate? You prefer to pay a floating rate when interest rates are going up or rates are going down? What are your thoughts? What do you think? When would you prefer to pay a floating rate? When interest rates are going up or rates are going down? And this was paying a floating rate, right? You're paying floating rate and you wanted to switch to fixed because you thought interest rates are going up. Yeah, when rates are going down, you will prefer to pay floating rates, right? Now let's see what happens if you are originally paying a fixed rate. Right, so let's leave out the amount. Okay, let's input the amount. Now let's say you are paying a rate of 15% fixed on your loan of 10 million, and you find that interest rates are going down, right? So if that is the case, you will want to switch from paying fixed to paying floating. Right? So what you do is you go to the bank, a swap bank, and you ask them what they can do for you. So they will say they will ask you to pay a rate of PLR plus maybe 3%. And the bank will pay you perhaps 12%. But sorry, let's assume the bank asks you to pay a floating rate at PLR. Right? Let's not complicate. We'll say just PLR. And in turn, the bank will pay you a rate of 12%. Now, what are the net interest payments? Okay, now this time let's leave out the capital because capital is the same. Let's just look at the interest payments only. 15% you're paying. So it's minus 15%. Then PLR also you're paying. So minus PLR. Right? And 12% you are receiving. So the 15% comes from the original loan which you're paying. Now, if you look at the net payments, it is minus PLR minus 3%, which is minus PLR plus 3%. Right? So you end up paying a rate of PLR plus 3%. Now, originally you were paying a rate of 15%, which is fixed, and you end up paying PLR plus 3%, which is a floating rate. So you have switched from paying fixed to paying floating. Right? This is called an interest rate swap, which facilitates the payment of converting a fixed rate loan into a floating rate loan. Right? So this is how swaps work. This is called interest rate swaps. These are called interest rate swaps. In other words, IRS, the most common type of swaps, interest rate swaps. Then you can also have currency swaps. Currency swaps, right? Currency swaps work if, let's say, you are a foreign investor, right? You're a foreign investor, and you are planning to invest in Sri Lanka. And a foreign investor planning to invest in Sri Lanka, so they will bring dollars into the country. So let's say they brought $1 into the country. This investor brings $1 into the country. Now, if the investor feels the exchange rate is going up, right? The exchange rate, let's say now is 185, and he feels the exchange rate will go up to 200, right? Let's assume. So if that is the case, he will not want to convert this straight away into rupees. And that will not be advisable right now, because if he converts now, he'll get 185, but if he holds on for a little longer, he might get 200. So that is the expectation, let's assume, right? Now in this case, he will not want to hold on to his dollars also, because he needs to invest this. He needs to start earning returns. Now look at the stock market return. And during the month of September 2020, Sri Lankan stock market was the best performing market in the world. That's fantastic. So this guy will want to convert his dollars and straight away invest in the stock market, because the market has gone up last month 12%, and this month also maybe he expects the market to do equally well, right? So what he can do is he can do what is called a currency swap. Currency swap. Now in that case, he doesn't have to sell his dollars, right? What he can do is he can lend his dollars he lends his dollars at, let's say, 1%. is $1 he lends at 1% to swap bank, and swap bank will agree to pay him to lend him rupees, maybe 185 at 10%. Right? So he has exchanged his dollars, he has given his dollars at a rate of 1% to swap bank, and swap bank is giving him rupees 185 at a rate of 10%. Right? So if you look at the net payments for the investor, he has lent $1 at 1%. So he's receiving interest on that. So let's say this arrangement is for 1 year. He will receive 185, sorry. In dollar terms, he will receive interest of 1% at 1%. And he will have to pay rupee interest of 185 into 10%. This is in rupees. Right, so the net payment will be $1 minus rupees 18.5. Okay, so this is the net interest after 1 year. From investors' point of view. Right. Now, can you look at this equation and tell me what is the risk to the investor? Is the investor exposed to a risk? Right now, originally, he has not sold or converted his dollars into rupees. He has just lent it out to the bank. And the bank has lent it rupees. Right? So it's just a lending arrangement. Nothing more than that. Not a conversion, not a sale of dollars, and there won't be a purchase of dollars at the end. Right? After 1 year, the bank will return the $1 to the investor, and the investor will return 185 rupees to the bank. And also, the bank will pay him 1 cent. That's interest, and the investor will pay the bank 18.5 rupees. So, what is the risk to the investor? Is he exposed to risk or not? Not. He's exposed to exchange rate risk. Can you tell me why? Why is he exposed to exchange rate risk? He will lose if what happens? If the dollar strengthens, will he lose? Or if the dollar weakens, will he lose? When will he lose? Exactly. Very good. Yes. And he was expecting the dollar to go up, the dollar to strengthen, right? For the dollar to go up to 200 rupees. So if that happened, if it actually went to 200 rupees, after 1 year, in rupee terms, he will be receiving 0.01 into 200 minus 18.5. Right? So this is 20 minus 18.5. He will make 1.5 rupees if his view is correct. But what if the dollar weakens? What if it comes to 150? If the exchange rate ends up at 150, this will be 50 rupees. Minus 18.5. So you'll end up losing 3.5, right? So he's still exposed to exchange rate risk. Yeah. All right. Sorry, I think it's not 15, it's 1.5, isn't it? And the earlier one would have been 2, right? So anyway, the risk is if the exchange rate goes up, he will benefit, but if the rate comes down, he will lose. That is because he's still holding on to his asset of $1. He hasn't sold it, he hasn't converted. He's still exposed to exchange rate risk. All right. Okay. So that is called a currency swap. That's why you switch from one currency to another currency through a swap arrangement rather than an outright sale. Currency swaps. Now, these are not the only types of swaps. There are many other types of swaps. You can switch from debt to equity. And switch from debt to equity. That's called a debt to equity swap. Then you have credit default swaps. Now, credit default swaps are what caused the subprime mortgage crisis, 2008. Credit default swaps. Right. Way back in 2008. So what happened was, there were like insurance companies, banks were engaged in selling credit default swaps. So every year, the insuring party was supposed to pay them a premium, right? So annually the premium was kept paying. Now, this product had no payout whatsoever for as long as there was no default in loans. But the moment defaults began, they were supposed to settle their obligations, right? So that caused the collapse of Lehman Brothers. Credit default swaps, very complicated thing. Okay, so that's on swaps. I hope it was clear. Any questions on swaps? No questions? Right, so that covers derivatives. Okay, so we did 4 types of derivatives. Forwards, futures, options, and swaps. Right, so let's move on to the next area. Debt to equity swaps. Yeah, sure. Before I explain debt to equity swaps, I'll quickly run through the interest rate swap again because I think the screen was not very clear. If you were paying 15% on 10 million at the original loan, and you felt interest rates are going down, what you can do is you can go to the bank, a swap bank, and you will pay them PLR. The bank will pay you, let's say, the rate of 12%. So your net payment will be minus 15% plus PLR minus 12%. And so you end up paying sorry, this is minus PLR plus 12%. Right, so you end up paying minus PLR plus 3%. So this is, you are switching from fixed rate, paying a fixed rate, to paying a floating rate. You end up paying a floating rate. If this, you will benefit if interest rates go down. Right? You will actually benefit if the PLR comes to 12% or below. Because at 12%, you will end up paying 15%, and below 12%, if PLR falls, let's say, to 10%, you end up paying 13%. Whereas originally you were paying a rate of 15%, right? So that's switching from fixed to floating. Then floating to fixed, if you feel interest rates are going up, the original loan, let's say, is based on PLR plus 3%. You go to the swap bank, they will ask you to pay PLR. The bank will pay you a rate of 10%. Now, if you look at the cash flows, you will end up with minus PLR plus 3%, which you are originally paying. And through the swap arrangement, you end up paying PLR and you receive 10%. Oh, sorry. The bank will ask you to pay a rate of 12% and you will receive PLR. You receive PLR, you pay 10%, 12%, sorry. I mean, it's 10%. So you receive PLR and you pay 10%. Original loan, you're paying PLR plus 3%. So this comes to minus PLR minus 3% plus PLR minus 10%. PLR cancels off. You end up paying a rate of 13%. Okay, so you were paying originally a floating rate. Now you have switched to a fixed rate. This is called floating to fixed interest rate swap. Right. You will benefit if interest rates go up. In fact, if the PLR goes above 10%, right? For example, at 10%, you end up paying PLR plus say is 13. But if PLR goes to 15%, you would have paid 18, but now you end up paying only 13. Right? So you're hedged. It's called an interest rate swap. Okay, so debt to equity swap. Right. Can be structured in two ways. Now, let's say you are an investor and you have invested in debt. You're the investor. You have invested, let's say, 1 billion rupees. Debt meaning debentures, bonds, and all that. Right. So you have invested in debt capital, something like a debenture. Invested 1 billion rupees. On this, you're earning an interest. You be paid interest on your investment. Right? This interest can be maybe 12%. You're receiving a rate of 12%. Now what happens is you feel the stock market is going to go up, right? Returns are going to be fantastic. So you're not happy with a return of 12%. You want to switch from paying debt, from receiving debt, right? From being invested in debt, you want to switch to being invested in equity. But let's say you have no mandate to invest in equity. So what you can do is you can go to a swap arranger, let's say again swap bank, right? Now instead of putting a figure, what I'll call this is, let's say, the return on debt, right? So it will be based on some benchmark, maybe the return on the government treasury bond plus a percentage. So the swap bank will tell you to pay them the return on debt. And the swap bank will in turn pay you the return on the all share price index, right, on 1 billion. Notional amount of 1 billion. So the net payments, now you're receiving the return on debt. Okay. And here you're paying return on debt. And you're receiving the all share return, the return on the all share price index. Right. So remember, you have not sold any single asset. This is the swap arrangement. So this cancels off and you will be left with the return on the all share price index. Right. And you will benefit if the market continues to go up. Right. So I hope that was understood. Is that clear, Gerald? This is called a debt to equity swap. Understood? So originally you were getting the return on debt. Now you end up getting the return on equity. You have switched from debt to equity. Credit default swaps also happen in a similar manner. Right? So that is what sank Lehman Brothers, because the defaults got triggered. Okay, so any more questions? If you have no further questions, we can move on to the next area, which is the final area in the syllabus. Right, so we are on to the last lab. On asset and liability management. Right. Now, managing assets and liabilities of a bank is very crucial. Why? Because that is the bread and butter of banking, managing your assets and liabilities. You get liabilities in terms of deposits, right? So you take deposits and you lend it out, which are your assets, right? So the return that you get on your assets should be greater than the cost of your liabilities. Then you make money. Otherwise, you end up losing money. Okay. So managing your assets and liabilities is very important. In a bank, it is done by a committee called the ALCO, the Asset and Liability Committee. So bankers make decisions every day on buying and selling securities, making loans, funding their investments, right? So these are on the asset side. These decisions are based on the outlook of interest rates, composition of assets and liabilities, and degree of willingness to take risk. Right? So the decisions that you make are based on so many factors. And it could be your view on interest rates. If you feel interest rates are going up, then your position will be different from when you feel interest rates are going down. These decisions will affect the bank's net interest income and balance sheet values. Right? So these are the most important things that ALCO will look at. They will look at the net interest income and the net worth of a bank. ALCO is the process of making such decisions about the composition of assets and liabilities and the risk management, known as ALM, Asset and Liability Management. These decisions are made by Assets and Liabilities Management Committee, or the ALCO. ALCO is responsible for overall financial direction of the bank. ALCO's goal is to manage the sources and uses of funds on the balance sheet and off-balance sheet activities with respect to interest rate risk and liquidity risk, right? So remember, ALCO will focus on interest rate risk and liquidity risk. They will also focus on other types of risk, but mainly interest rate risk as well as liquidity. Asset and liability management is generally short-term. Remember, it is short-term. It's not a long-term strategic committee. It's a short-term committee, but still they make very crucial decisions for the bank. And they try to achieve near-term financial goals, right? So their objective and their time horizon is short-term. Traditional purpose is to control the size of the bank's net interest income. It's a goal associated with what is called a dollar gap, right? So they will look at net interest income. That is the most important thing that the ALCO will look at, net interest income. This is based on what is called dollar gap, which we will come back to later. And ALM also considers the effects of changes on the value of the balance sheet items. Right? They will look at how your assets and liability values will change. It is a goal associated with duration gap. Now, if you all could remember duration, okay, we'll come back to duration later. Changes in the value of balance sheet items. How does balance sheet items change? That is called duration gap, measured through duration gap. So let's see, you come back. Now, net interest income is the difference between interest earned on assets and the cost of liabilities, right? So net interest income is your interest income minus interest expenses. This you need to remember. Net interest income minus interest expenses. Net interest margin is the net interest income, right, divided by earning assets. So it's net interest income divided by earning assets. So these equations you need to remember, very, very important, crucial. Let's try this example. ABC has total assets consisting of 100 million in 5-year fixed rate loans at 8%, 90 million liabilities consisting 30-day time deposits at 4%. You asked to calculate net interest income and net interest margin. What happens if interest rates change by 2%? Okay. Sorry, one more thing I could mention is net interest margin is net interest income divided by earning assets. Now, what do you mean by earning assets? What are earning assets? Earning assets are assets which earn you interest income. Now, there are some assets like cash, for example, don't earn interest income. So cash is not an earning asset, right? Whereas land and buildings are also not earning assets. They don't earn interest income. Understood? All right, so let's get back to the question. ABC has total assets consisting of 100 million in 5-year fixed rate loans at 8%, 90 million liabilities, 30-day time deposits at 4%. Asked to calculate net interest income. Net interest income is your interest income. The exam, you must always write equations minus interest expense. $100 million 5-year fixed rate loan at 8%. So 100 million you are given for 5 years at rate of 8%. The 90 million liabilities consisting 30-day time deposits at 4%. Right, so it is 8 minus 3.6 comes to $4.4 million. That is your net interest income, correct? all of you get this answer? Net interest margin is your net interest income divided by earning assets. Right. So net interest income is $4.4 million divided by earning assets. You have 100 million assets. Which is 4.4%. That is your net interest margin. And now the second part of the question. You are asked to calculate net interest income and net interest margin assuming interest rates increase by 2%. Now what happens if interest rates go up by 2%? What happens to your net interest income? Actually, it has total assets, 5-year FDs, 5-year fixed rate loan at 8%. So your loan is fixed for 5 years at 8%, meaning if interest rates go up by 2%, the 8% rate will not change. For the next 5 years, it is fixed at 8%. So it remains at 8%. Right? Whereas 30-day time deposits going at 4%. So after 30 days, it will get repriced to 6% because rates are going up by 2%. Isn't it? Now this goes up to 6%. So your interest income remains at 8 minus interest expense shoots up to 5.4. So you end up with 2.6 million dollars of net interest income. So what happens to your net interest margin? It drops to 2.6%. Right? So interest rates went up, but you lost money as a result. Why? Because you have a long-term asset. Your asset is 5 years fixed, whereas your liability is short-term liability, and interest rates gone up. Right? So no sooner your liability gets repriced, it gets repriced at 2% higher, you get hammered on it, whereas your income remains fixed. Okay, so that will shrink your net interest margin. Your net interest margin will reduce as a result. Clear? Okay, Gerald, well, I looked at it for a 1-year period. Right. So this calculation was based for 1 year. If you look at the entire 5 years, yes, you're right. But this is for 1 year. Right. So I should have mentioned it probably. I'm looking at the first year. Okay, so if you are looking for 5 years, it will be 5 times this. Right. Any more questions? Okay. Net interest income depends on the interest rates of assets and liabilities. Right. Increase in the interest rates on assets will increase net interest income. An increase in interest rates on liabilities will reduce net interest income. Right. Obviously, now, like what happened in this example, if interest rates on assets go up, in this case it didn't, but if interest rates on assets go up, it will increase net interest income. And the interest rate on liabilities goes up, like what happened here, it will reduce your net interest income. Okay, that is because your interest expense will increase. The amount of the various earning assets and liabilities increasing the size of the bank will increase net interest income. So that's the other thing you can do. Instead of changing interest rates, the amount of your assets and liabilities can also increase. Right? So if you want to grow, your balance sheet also has to grow. That is one way of increasing. On the same return, if net interest income remains unchanged, or net interest margin remains unchanged, if you grow the size of your balance sheet, then automatically your interest income will increase. The earning mix of those funds, shifting earnings towards more high-yielding assets or less costly sources of funds, will increase net interest income. So those are the combinations, isn't it? Net interest income is your interest income, which is the total assets into return on assets, or the interest earning assets, minus your liabilities, or your interest-sensitive liabilities into the interest cost. So interest rates depend on demand and supply of funds. They are determined by interaction of thousands of credit suppliers and demanders, which makes it difficult to predict interest rates. Now, predicting interest rates is very difficult. If I may ask you what your views on the next 6 months, right? Your 6 months forecast of interest rate is, if there are 15 of you, each of you will have different opinions. No single person will have the same view. Very difficult to form a precise view because there are so many combinations working in tandem. Interest rate consists of risk-free rate and risk premium to compensate credit, inflation, maturity, marketability, call risk, and so on. So if you look at a housing loan interest rate, let's say maybe 10 years fixed at 9%. Now this 9% is depending on so many factors, so many other factors, right? Not just you don't look at a person's face and give an interest rate. There are other factors that you need to consider. Repayment capacity, inflation, maturity, the tenor, all that. So managing interest rates, you can use balance sheet adjustments, on balance sheet adjustments, right? Something you can do to your balance sheet. Changing the portfolio of assets and liabilities in order to change the manner in which profitability of the bank or dollar amount of assets and liabilities change as interest rates change. Right? So you can have a look at the assets and liabilities. Now in this case, if interest rates are going up, you will want to have short-term assets, long-term liabilities, because if you have short-term assets, and when interest rates go up, they will get repriced at a higher rate. Okay, so the return that you get will also increase as a result. And if you have long-term liabilities, if interest rates keep going up, your interest expense will remain fixed for a longer tenor. Right? Management may adjust the maturity, repricing, and payment schedules of its assets and liabilities. You can securitize some of its assets and sell them to investors. Remember securitization that we did? That generates additional liquidity for the bank. Then you can have off-balance sheet adjustments. This is where you use derivatives. Without changing assets and liabilities, banks can do the same using off-balance sheet derivatives, such as interest rate swaps and futures, right? So that's what we did about half an hour ago. Now, if you feel interest rates are going up, you need to have short-term assets, long-term liabilities. So, and also you can use receive fixed, pay floating interest rate swaps, right? Banks can enter into receive floating, pay fixed interest rates swaps to protect them from increasing interest rates, what we discussed earlier. And banks can also sell treasury futures to protect from increasing interest rates. Now, when interest rates go up, right, treasury futures are bonds. If interest rates go up, the value of the bond will fall, right? So what you need to do is you need to go short treasury bonds. If you go short on bonds, if interest rates go up, the price of the bond will fall and you will gain. And you will be protected against an increasing interest rate. Right. So interest rate risk consists of price risk and reinvestment risk. Now, reinvestment risk is, let's assume you had invested 10 years ago in 10-year bonds, right? The rate at that time may have been attractive in 2010. So you invested in 10-year bonds. So let's assume in 2010 you had invested in 10-year bonds at a rate of 10%. Now, 10 years down the line, in 2020, interest rates have dropped steeply. The 10-year bond is now going at 7%, right? So when the bond matures, which was going at 10%, you will be reinvesting at a rate of 7%. So you get hit on reinvestment. That's called reinvestment risk. To measure interest rates risk, banks use dollar gap, duration gap, and simulations. So let's see what each of these are. Right. So the dollar gap, we'll start off with the dollar gap. This is the most commonly used method by banks, right? Dollar gap is very simple. It's basically the rate sensitive assets minus rate sensitive liabilities. So let's see what it means. It's also known as the funding gap or the maturity gap. Now remember these two names. Dollar gap is known as the funding gap or the maturity gap. You need to remember that. Banks classify all the assets and liabilities into groups of interest rate sensitive or non-interest rate sensitive according to whether their interest return and cost varies with the general level of interest rates, right? So certain assets are interest sensitive, like what we discussed earlier, like loans. Floating rate loans are interest sensitive, whereas fixed rate loans, if you had given a 20-year housing loan fixed, it's not interest sensitive. Cash is not interest sensitive. Then on the liability side, liabilities like equity is not interest sensitive. The focus on when it comes to funding gap or the maturity gap, in other words, the dollar gap, is on net interest income, right? So if you are looking at net interest income, then you need to consider the dollar gap. Gap analysis classifies assets and liabilities according to their interest rate sensitivity. Interest sensitive assets or liabilities are those that reprice within some defined period. Right? So if a liability or an asset is interest sensitive, when the liability or asset comes for repricing, not necessarily maturity, repricing. Now, because maturity and repricing are two different things, right? Now you can have a 20-year housing loan, two options. One is fixed, right? Something like this. Say your housing loan fixed for 20 years. This is the first one. The second one, so this is, let's say, fixed at 10%. Second one is 20 years, 6 months floating at PLR plus 2%. Both are 20-year housing loans. Both of these 20-year housing loans. First one, fixed for 20 years at rate of 10%. Second one, 20-year housing loan, but every 6 months the rate keeps changing at PLR plus 2%. Right? So every 6 months the rate changes. Now this is not interest rate sensitive. Why? For 20 years the rate is fixed. In between, whatever happens to rates, the return you get is fixed at 10%. Whereas this, every 6 months, the rate keeps changing. So every 6 months, this becomes interest sensitive. Yeah? So although both are 20-year loans, the nature of these loans are different, very different. Okay. So interest sensitive assets and liabilities are those that reprice within a defined time period. Now this loan, the loan B, for example, reprices every 6 months. So you need to consider, when you look at dollar gap, you need to consider repricing, not the maturity. And repricing frequency, every 6 months. But this one reprices only once in 20 years. Consider repricing frequency rather than the maturity. Rate sensitivity depends on the frequency and repricing. Short-term assets and liabilities are more rate sensitive than long-term assets and liabilities. Short-term assets and liabilities are more rate sensitive and long-term. Assets and liabilities with long-term maturity with variable rates are interest rate sensitive, right? So this is a long-term asset, but variable interest rate. So this is therefore interest sensitive. Rate sensitive assets, if asset rate sensitive assets, if asset interest rate return varies with interest rate changes over some given time horizon, is referred to as rate sensitive assets. Assets that are repriced within the time horizon are rate sensitive assets, right? So within 6 months, within a 6 months period, loan B is rate sensitive. Whereas if you look at 6 months period, loan A is not rate sensitive. Assets that reprice within a given time horizon are rate sensitive assets. So within 6 months, B is rate sensitive, A is not rate sensitive. Short-term securities issued by the government and private borrowers, variable loans, for example, are rate sensitive assets. Non-rate sensitive assets are assets which do not vary when interest rates changes over some time, right? Like long-term securities issued by the government and private borrowers at fixed rate. Sometime back, the government issued 30-year bonds. So those are not rate sensitive for the next 30 years. Because if you buy a bond and you hold it until maturity, they're not rate sensitive. Wall cash is not rate sensitive. Long-term loans are not rate sensitive. Land and buildings are not rate sensitive, right? Then rate sensitive liabilities. Like rate sensitive assets, you also have liabilities which are rate sensitive. If a liability's interest cost varies with interest rate changes over some given time horizon, it's referred to as rate sensitive liabilities. Liabilities that reprice within the time horizon are rate sensitive liabilities. Right. Now, for example, if this was a loan, let's say you have raised a debenture. And if these were debentures that the bank has raised, and the bank, let's say, has issued a 20-year debenture fixed rate of 10%. Then B is another debenture, 20-year maturity, but the repricing frequency is every 6 months. So repricing frequency every 6 months. Now, in this case, A is not rate sensitive, although it is a liability, is not rate sensitive for 20 years. B is rate sensitive every 6 months. Okay, so if a liability's interest cost varies with interest rate changes over some given time horizon, they are referred to as rate sensitive liabilities. Liabilities that reprice within the time horizon are rate sensitive liabilities. Right? So within 6 months, B is rate sensitive, A is not rate sensitive. Money market borrowings and deposits. Short-term savings accounts, overnight interbank borrowings, rate sensitive assets, liabilities. Central bank borrowings, variable rate deposits, all rate sensitive. Non-rate sensitive assets. If assets interest cost does not vary with interest rate changes, they are referred to as non-rate sensitive liabilities. Right? It's actually not assets, it has to be liabilities. My apologies for that. So if a liabilities cost does not vary with time, it's called non-rate sensitive liability. For example, current accounts. No, you don't pay interest in Sri Lanka. So current accounts are not rate sensitive. Long-term savings, something like a 5-year FD. Equity, not rate sensitive. Then the dollar gap. Right? Dollar gap. The selection of time period over which rate sensitivity of assets and liabilities is crucial. Right? You need to consider what time horizon you're looking at. Whether you're looking at 3 to 6 months, 1 week up to 1 week, maybe up to 1 month, then maybe 1 month to 3 months, 3 months to 6 months, 6 months to 1 year, likewise. An asset or liability that is rate sensitive on time period may not be rate sensitive in the short term. Okay. Now, for example, this one, B. Right? B's interest rate keeps changing every 6 months. So every 6 months it becomes rate sensitive. But if you take a 1 month period, it is not rate sensitive because you have to wait for 6 months for the rate to change. Right? So although it is rate sensitive in 6 months, it is not rate sensitive in 1 month. An asset or liability that is rate sensitive on time period may not be rate sensitive in short term. The time period is referred to as maturity buckets or planning horizons. There is no standard, and each bank can decide on the maturity bucket, right? So you can decide on your own bucket. Nothing is fixed, nothing cast in stone. In the long term, every asset and liabilities become rate sensitive. That is because if you take long term, maybe a 50-year time period, even this 20-year loan becomes rate sensitive. So let's try this. Which of the following assets and liabilities fit the 1-year repricing sensitivity test? Okay, so let's try. I'll give you a minute to try this. right? So what do you think? Which of the following assets or liabilities fit the 1 year rate or repricing sensitivity test, right? So you're looking at a period of 1 year. Within 1 year, which of these are rate sensitive? 91 days are rate sensitive within 1 year. 1 year treasury notes are rate sensitive. 20-year treasury bonds are not rate sensitive, right? Because you're looking at a 1 year time period, 20 years is not rate sensitive. And 20-year floating rate corporate bonds with annual repricing are rate sensitive within 1 year, because although the maturity is 20, every year the rate keeps changing. 30-year floating rate mortgages repricing every 2 years is not rate sensitive in 1 year. 30-year floating rate mortgages repricing every 6 months is rate sensitive, right? Because every 6 months the rate keeps changing. So within 1 year, it is rate sensitive. Overnight Fed funds, obviously rate sensitive. 9-month fixed rate CDs are rate sensitive. 1 year fixed rate CDs are rate sensitive. 5-year floating rate CDs with annual repricing are also rate sensitive. Common stock, remember, is not rate sensitive. Right, so any questions up to now? No questions, right? Let's move on. The dollar gap is the difference between the amount of rate sensitive assets and rate sensitive liabilities within a given time bucket, right? Total effect of interest rate changes on profitability is summarized by the dollar gap. Dollar gap is the difference between rate sensitive assets and rate sensitive liabilities. So it's rate sensitive assets minus rate sensitive liabilities. You need to remember this. Positive dollar gap means the bank is asset sensitive. Positive means there are more assets than liabilities maturing. Negative dollar gap means the bank is liability sensitive. So if the dollar gap is negative, you have more liabilities than assets maturing. Right, so let's find this. Let's find the dollar gap for a 1 year time horizon. What is the dollar gap for a 1 year time horizon? Right, so what's your answer? Dollar gap? is your rate sensitive assets minus rate sensitive liabilities. Right, so what we'll do is, let's assume this is a 1 year time period. For 1 year, what are your rate sensitive assets? All cash, not rate sensitive. On the asset side, the short-term securities are rate sensitive. Long-term securities are not rate sensitive. Variable loans are rate sensitive. Short-term loans rate sensitive. Long-term loans not rate sensitive. Other assets, let's assume, are not rate sensitive. These are your rate sensitive assets minus your rate sensitive liabilities. Demand deposits, zero interest, so not rate sensitive. Money market deposits are rate sensitive. Short-term savings are rate sensitive. Long-term savings not rate sensitive. Central bank borrowings are rate sensitive. And equity is not rate sensitive. So it's minus 40. That is your dollar gap, which means your liability sensitive. Right, so you're liability sensitive because you have more liabilities maturing than your assets. Right. Now you would be better off if you're liability sensitive if interest rates go down, because you have invested, you have long-term liability, long-term assets and short-term liabilities. Right, so when these liabilities mature and rates go down, your cost will reduce. Then you will benefit. Okay. The relative gap ratio expresses the amount of gap. Right? So dollar gap divided by earning assets. Sorry, total assets. Right? Relative gap ratio is your dollar gap divided by total assets. Expresses the amount of rate sensitive assets and rate sensitive liabilities as a percentage of total assets. Remember, not earning assets, but as a percentage of total assets. So it's dollar gap divided by total assets, right? As I said, these equations you need to remember. Interest sensitive ratio, rate sensitive assets divided by rate sensitive liabilities. If the ratio is above 1, it means you're asset sensitive. That means you have more assets than liabilities. Ratio below 1 means the bank is liability sensitive. Now, this is the most important thing. Most important thing with dollar gap is to calculate the change in net interest income. So remember, the change in net interest income is your dollar gap into the change in interest rates. This equation you need to remember. Okay. Your change in net interest income is the dollar gap into change in interest rates. Now, your objective of any bank's objective will be to increase. Sorry, and any bank's objective will be to increase net interest income. No one will want to reduce it. Right? So your change will have to be positive change. Positive means your net interest income is increasing. Right? And if you expect interest rates to go up, should you have a positive dollar gap or a negative dollar gap? Now remember, these two are multiplication. You are multiplying dollar gap by the change in interest rates. Right? So you multiply two positive numbers, you end up with a positive number. You multiply a positive and a negative number, you end up with a negative number. Remember what we did? Grade 2. Right. Now your objective is to increase net interest income. So this has to be a positive number. If dollar gap, if interest rates are going up, the change in interest rates is also positive, which means the dollar gap has to be positive. Then you will end up with a positive figure. Now objective is to increase interest rates. You expect interest rates to go down, meaning you should have a negative dollar gap. Right? Objective is to increase in net interest income, and you expect interest rates to go up. Right? You expect interest rates to go up, so you run positive dollar gap. But interest rates drop because interest rates are beyond your control. You can't control what is happening to interest rates in the economy. If this happens, then your net interest income will drop. Objective is to increase net interest income. You expect rates to go down, so you run a negative dollar gap. But interest rates suddenly go up, you will see that your net interest income will reduce. Okay. Now this is what is mentioned in the previous slide that we skipped. This one. This is all that there is in it, right? So if you remember this combination, you understood this slide. Okay, so let's try this question. Consider the following balance sheet for bank ABC. Right, so you are being given assets and liabilities. They have a floating rate mortgage, 30-year fixed rate loan, demand deposits, time deposits, and equity. What is ABC's expected net interest income at the end of the year? Okay. What will be the net interest income at the end of the year if interest rates rise by 2%? The next question is using cumulative repricing gap model. What is the expected net interest income if a 2% increase happens in interest rates? Right. So let's get to the third one later, but let's try the first two questions. First question: what is ABC's expected net interest income at the end of the year? So let's calculate. Net interest income is your interest income minus interest expense. So interest income, floating rate mortgage going at 10% annually. 50 into 10%. 30-year fixed rate loan at 7%. 50 into 7%. This is on the asset side. You know, liabilities, you have demand deposits going at 6% annually. Then your time deposits also going at 6% annually. Equity, you don't pay anything. This is 5. It's 8.5 minus 5.4, which is 3.1. Net interest income 3.1 positive, right? So that is the net interest income at the end of the year. What will be net interest income at the end of the year if interest rates go up by 2%? If rates go up by 2%, what happens? Let's see. Now, if you all could remember, you can use the previous equation. The change in net interest income is your dollar gap into change in interest rates. Right? The change in net interest income is your dollar gap into change in interest rates. change in interest rates are going up by 2%. Change in interest rates plus 2%. So you know that the change in interest rates. Now you need to calculate dollar gap, which is your rate sensitive assets minus rate sensitive liabilities. Rate sensitive assets, floating rate mortgage, rate sensitive within 1 year, annual repricing. The amount is 50. 30-year fixed rate loan is not rate sensitive. Right, so you have only one asset which is rate sensitive. And liabilities, you have demand deposits going at 6% changes annually. You have 70 time deposits, 6% annually. Okay, so time deposits, let's assume is an annual time deposit. Equity is not rate sensitive. So you have 50 minus 90 is minus 40. You are liability sensitive. Right? Liability sensitive and interest rates have gone up. So your net interest income would have dropped. So the change in net interest income is minus 40 into 2%. Minus 0.8. Net interest income will drop by 0.8. So your net interest income after 1 year, you come to 3.1 minus 0.8, 2.3. Now you can calculate same thing using this equation once again. But you will end up with interest rates are going up by 2%, so this goes up to 12%. This doesn't change. This goes to 8%. Here also 8%. You get the same answer. Third one will come back later. So I hope that was clear. So let's move on to the next area, incremental and cumulative gaps. Incremental gaps. Now, if you all could remember, we did cumulative cash flows when we were doing a payback period. This cumulative gap is something similar. Incremental gaps measure the difference between rate sensitive assets and liabilities over increments over the time horizon. Cumulative gap measures the difference between rate sensitive assets and liabilities over a more extended period. Right? So within a given period, what is the rate sensitive assets and liabilities is incremental gap. Now, if you are combining two or three periods, you can look at cumulative gaps. Cumulative gap is the sum of incremental gaps. If there is only one planning horizon, the incremental gap and the cumulative gap are the same. Right, so let's take this example. Now, if you look at the first row, right, 0 to 30 days, you have assets of 50 million maturing and liabilities of 30. Right, so your rates, your gap, dollar gap is 50 minus 30, which is 20. Right. So if you are looking at just 0 to 30 days, your cumulative gap is also 20. Right now, if the planning horizon is the same, then incremental gap is equal to cumulative gap. Right. Then if you are looking at the next planning horizon, from 31 to 90 days, you have assets of 25, liabilities of 20, which means from 31 to 90 days, an incremental gap of dollar gap of 25 minus 20 of 5 exists, right? So 0 to 30 days, you have an incremental gap of 20, 31 to 90 days, incremental gap is 5. So cumulative gap from 0 to 90 days, right? I repeat, from 0 to 90 days is 20 plus 5, 25. Then 91 to 180 days, no assets maturing, only liabilities. You have an incremental gap of 0 minus 20 minus 20. Cumulative gap from 0 to 180 days will be 20 plus 5 minus 25. You end up with 5. 181 to 365 days, no assets, only 5 liabilities of 5. So your incremental gap is -5. Cumulative gap is from 0 to 365 is 20 plus 5 minus 20 minus 5, 0. Right, so if you look at 0 to 365 days, your cumulative gap is 0. And your incremental gap will also be 0 because you have 75 assets and 75 liabilities. Your incremental gap is 0. Right, so let's try the next question. Use the following information about a hypothetical government security dealer named MP Jogan. Market yields are in parentheses and amounts are in millions. Right, so you have cash, 1-month treasury bills, 3-month treasury bills, 2-year notes, 8-year notes, and 5-year municipal bonds, which resets every 6 months. Then you have, on the liability side, you have overnight repos, subordinated debt, 7-year fixed rate debt, equity. Right, what is the funding or repricing gap if the planning period is 30 days, 91 days, 2 years? Okay, so let's try this. What is the impact over the next 30 days on net interest income if interest rates increase by 30 basis points or reduced by 75 basis points? So let's calculate and see. So let's start off with 30 days. The funding gap is rate sensitive assets minus rate sensitive liabilities. So let's do 30 days initial. And for 30 days, it will be rate sensitive assets 30 days. 1-month treasury bills are rate sensitive. Sorry, cash is not rate sensitive. 1-month treasury bill rate sensitive 75. 3-month treasury bills not rate sensitive. 2-year treasury notes are not rate sensitive. 8-year notes are not rate sensitive. 5-year municipal bonds every 6 months repricing is not rate sensitive in 1 month. Then on the liability side, you have overnight repos 170. Subordinated debt, 7-year fixed rate, not rate sensitive, equity, not rate sensitive. Right? So you end up with 95 minus. We can answer part B straight away. What is the impact over the next 30 days on net interest income if interest rates increase by 50 basis points? So your funding gap is minus 95 and interest rates are going up by 0.5%. Right. So your change in net interest income is the funding gap into change in interest rates. So if change in interest rates is 50 basis points, the change in interest rates 0.5%. If rates go up by 0.5%. Funding gap 95 minus into 0.5%. Right? So your net interest income will drop. By 0.475. Then if interest rates drop by 75 basis points, the change in net interest income will be 95 into 0.75% minus. Right? You see that your net interest income will increase. It's a positive effect. Point 0.7125. Right, so that is 30 days. Then 91 days. Your funding gap. Rate sensitive assets, 91 days, 1 month treasury bills are rate sensitive. Cash is not rate sensitive, 1 month treasury bills rate sensitive. 3 months treasury bills are rate sensitive. 2-year notes not rate sensitive, 8-year notes not rate sensitive, 5-year munis, 6 months repricing are not rate sensitive, right? So these are your rate sensitive assets minus rate sensitive liabilities. Overnight repos rate sensitive. 7-year fixed rate debt is not rate sensitive, so that's it. You will get minus 20. Equity is not rate sensitive. Right, so 91 days you have a negative funding gap of minus 20, of minus 20. Right? So if interest rates go up, you will lose. Rates go down, you will benefit. Likewise for 2 years, similar calculation. 2 years, 1 month is rate sensitive. 3 months rate sensitive. 2-year notes rate sensitive. 8-year notes are not rate sensitive. 5-year munis, 6 months repricing are rate sensitive. Then on liability side, repos rate sensitive. 7-year fixed rate debt not rate sensitive. Okay, so you have positive funding gap for 2 years. Then if interest rates go up, you benefit. Rates go down, you will lose in 2 years. Okay, so I hope that was clear. Yeah, in fact, well, 1 month you have a negative funding gap. Right? So if interest rates go up, you will lose. Okay, the change in net interest income will be the funding gap into change in interest rates. So if interest rates go up, funding gap is negative, you will lose 0.475. Right? Then if interest rates drop, your funding gap is negative, and interest rates will drop, you will benefit because your net interest income will increase by 0.7125. Okay. All right. So any more questions? No more questions. Let's move on. Right. managing dollar risk, interest rate risk with dollar gap. A defensive ALM. A defensive ALM is where it's like this. Right? Defensive ALM is where you try to maintain your dollar gap close to zero. That means dollar gap close to zero means your rate sensitive asset should be equal to rate sensitive liabilities, almost equal. Then you maintain dollar gap zero. Now, if this is zero, whatever happens to interest rates, your net interest income does not change. So that's called defensive. Defensive strategy attempts to keep the amount of rate sensitive assets in balance with the amount of rate sensitive liabilities over a given time period. So that dollar gap will be near zero. This tries to reduce volatility in net interest income. The focus of defensive strategy is to insulate the net interest income from interest rate changes, whether the direction of interest rate movement is upward or downward, predictable or unpredictable. This strategy is not necessarily passive, since many adjustments are needed to maintain a zero gap. Unexpected payments of a loan or inflow of deposits. There is no need to forecast interest rates, right? So the beauty is whatever happens to interest rates, your net interest income will not change. You don't have to forecast interest rate movements. Now this suits smaller banks, which has lesser capacity to absorb losses, right? So it doesn't mean you just wait like this. You have to be active because you keep getting deposits and you have to grant loans. But overall, you have to keep your dollar gap close to zero and net interest income close to zero. That's called defensive. Issues under defensive: profitability of the bank that does not take some interest rate risk might be inadequate. Right? So you're not aggressive, you don't care what is going on to interest rates, so you will not benefit either. No risk, no return. Difficult with the desires of the bank's customers, right? Now, for example, if you want to reduce your dollar gap, you will have to adjust your rate sensitive assets and liabilities. So you might not be doing what the customer wants. If the customer wants a long-term loan and you feel interest rates are going up, you might not be willing to lend long-term, but the customer will be unhappy. So the expertise management is sophisticated financial instruments, such as you need to use derivatives to do this. So it's not easy. Being defensive is tough. Then you also have aggressive ALM. Right? If you're aggressive, you have to forecast interest rate changes. It tries to raise the level of net interest income. The focus of aggressive strategy is to increase net interest income through altering the portfolio. You keep changing your portfolio, rebalancing it is called. Success depends on the ability to forecast interest rates. Right? So if you expect rates to go up, you should try to maximize dollar gap. It involves predicting the direction of interest rates, and adjustments must be made to interest rate sensitive of assets and liabilities in order to take advantage of projected interest rate changes. Right? Like prediction of interest rates increasing should result in shifting the portfolio to positive gaps. Right? So you try to benefit from interest rate movements if you are aggressive. Now this is what we discussed earlier. Remember the plus minus signs? Then the issue with dollar gap management, time horizon. Right? You assume that everything matures during a given period. Right? So if you take the short term, maybe 1 month, you assume that all your assets and liabilities mature on the same day. The gap ignores the time at which the rate sensitive assets and liabilities reprice within that time period. Implicitly, assuming that all rate sensitive assets and liabilities reprice on the same day. In a 30-day repricing period, they reprice in different days. And they may not reprice on the same day, might be on different days, but you assume that it happens on the same day. correlation with the market. The gap assumes that correlation between movements in interest rates and interest rate revenue and cost of the portfolio as one. You assume that correlation does not change. When interest rates increase by 10%, the revenue and cost will also change by 10%. You assume that everything will change by the same percentage. The return on assets and liabilities will not change by the same percentage usually in practice. Solution is to calculate standardized gap. There are all the rate sensitive assets and liabilities will be multiplied by correlation before calculating gap, right? So that's called standardized gap beyond the scope of your syllabus. The focus is on net interest income. Dollar gap focuses on net interest income. You don't care about net worth. So to address that, we have what is called duration gap. If you could recall, duration in fixed income is the weighted average maturity of cash flows, or the interest rate sensitivity of an asset or liability is measured through duration. Interest rate sensitivity. The duration gap is the difference between duration of the bank's assets and liabilities. Duration is the weighted average time to receive all cash flows from financial instruments. Duration gap measures the interest rate sensitivity that helps to explain how changes in interest rates affect the market value of assets and liabilities, and in turn, its net worth. Net worth is an indicator of solvency. Right? So net worth, the fundamental equation which we learned in grade 2 was your assets are equal to liabilities plus your equity or your net worth. Right. Right. So duration gap. Is the duration of assets, which I will in short write as duration of assets minus liabilities over assets into duration of liabilities. This is how you calculate duration gap. Now, using duration gap, you can calculate the change in net worth, which is your duration gap. Remember, there is a negative sign. This has to begin with a negative sign, right? Into change in interest rates divided by 1 plus interest rates into total assets. This gives the change in net worth. Right now, like we did earlier, remember this is a negative sign. Here, 1 plus interest rates always positive. Total assets always positive, unless you're bankrupt. Total assets also positive. So multiplying a positive number by a positive number, you get positive, and this positive into a negative is negative, right? So multiplying those factors gives you a negative number. Now your objective is to increase net worth, and you expect interest rates to go up. Right? So you're multiplying a negative into a positive into duration gap. Will have to be a negative duration gap. Okay, because you are multiplying 3 factors. You here negative sign. Then this is, if you expect to go up, it's positive, meaning your duration gap will have to be negative. Right? So if you expect interest rates to go up, you should have shorter duration assets, longer duration liabilities, meaning you should end up with negative duration gap. Then your net worth will increase. Likewise, if your objective is to increase net worth, there is a negative sign, and you expect rates to go down. So your duration gap has to be positive. Right? You should have long-term assets, short-term liabilities. Objective is to increase net worth. You expect interest rates to go up. So you have negative duration gap, but rates go down, your net worth will reduce. Objective is to increase net worth. You expect interest rates to go down, so you run positive duration gap, but interest rates increase. Your net worth will also reduce. Okay. So this is the combination which is given in the table. Now, what if you have a duration gap of 0? What if this is 0? Then regardless of what happens to duration gap, this is 0. You multiply, your net worth will not change. That's called defensive area. Right? Defensive. Okay, so let's try this example. You have assets and liabilities, cash of 100, duration is 0. Business loan 400, duration 1.25. Mortgage loan 500, duration is 7. So you have total assets of 1000, weighted average duration is 4. Right? Our weighted average duration is, if you calculate, multiply the amount into duration, get the weighted average, it comes to 4 in this. Likewise, deposits, you have a 1-year deposit going at 600 amount is 600, duration is 1. 5-year deposit, amount is 300, duration is 5. Equity is 100, no duration. Weighted average duration of liability is 2.33. So let's calculate duration gap. Duration gap is your duration of assets into liabilities. So assets into duration of liabilities. Always write your equation. Duration of assets is 4. Right? Liabilities of assets. Your liabilities of 900, assets 1000. The duration of liabilities 2.33. So this is 4 minus 2.33. $2.1. The duration gap is 1.9 positive. Right. Duration gap 1.9 positive means if interest rates fall, you will gain. Second part of the question, change in net worth. You have to calculate change in net worth if interest rates increase, right? Rates are going up, so you're in trouble. Change in net worth will be minus duration gap into change in interest rates divided by 1 plus your interest rate into total assets. So duration gap 1.9 minus. Don't forget the minus sign. Change in interest rates increased by 1%. 1 plus interest rates, 1 plus 11%. Total assets, 1000. Will drop by 17.12. Net worth will drop by 17.12. Okay, so any questions? Just use these equations and you will arrive at the answer. Issues with duration gap. It assumes a parallel shift in the yield curve. Right? It assumes that interest rates across all tenors will increase by the same amount or reduce by the same amount. Then it ignores convexity. Right? Remember convexity, what we did, fixed income. Duration gap ignores convexity. You need to rebalance often, but this will be costly. Right? In theory, it looks very easy, but in practice, very difficult and costly to rebalance because you have to keep paying transaction cost. Excuse me. Right. Simulations. Dollar gap, duration gap. Next one is simulation. It's possible to evaluate various balance sheet strategies under different assumptions under this. Right? You can do what-if analysis in simulation. So this is a computer-intensive model. We use various models, computer software to do simulations. Can be used to do stress testing. Now, how do you use derivatives to manage interest rate risk? Interest rate futures to hedge dollar gap. Right. So if interest rates are increasing, right, rates are increasing, you need to go have long-term assets, short-term liabilities. So long position in interest rate futures can be used to protect against falling interest rates. Right. Falling interest rates, if interest rates are falling, you should have long-term assets, short-term liabilities. If rates are falling, and so you need to go long interest rate futures. If bank has a positive dollar gap, when interest rates falls, and you have positive dollar gap, your dollar gap is positive, and you expect rates to drop, then your net interest income will drop. Remember the equation. So if that is the case, you should go long interest rate futures. Right? When interest rates falls, if a bank has a positive dollar gap, when interest rate falls, the net interest income will reduce. This will be offset by gains from long interest rate futures. Likewise, if you have a negative dollar gap and rates go up, is the risk, you should go short interest rate futures. When interest rate rises, reducing net interest income will be offset from the gains in short interest rate futures. So how to use interest rate futures to hedge duration gap? If a bank has negative duration gap, if duration gap is negative, right? If you have negative duration gap, that means you have short-term assets, long-term liabilities. Your risk is interest rates going up. Right? Negative duration gap, rates go up, you will lose. Okay, in that case, you need to go short interest rate futures. Right? To manage, the bank has to increase asset duration and reduce liability duration. As the bank can go long in futures, right? Because if you go long in futures and interest rates go up, then you will benefit. Sorry, this is futures, so don't get confused. Long futures is like you keep receiving. Yeah. Interest rate futures, long means you are paying a fixed rate. right? Receiving a floating rate. Then if interest rates go up, you will, if that is the case, if interest rates go up, you will lose. So you need to do the opposite. You need to receive floating, pay, sorry, you need to receive floating and pay fixed. That's called long interest rate future. Okay. Then if you have positive duration gap, your risk is positive duration gap, your risk is interest rates going down. Right? You need to go short interest rate futures. Right? If you have positive duration gap, to manage, the bank has to decrease asset duration, and the bank has to increase liability duration or go short interest rate futures. Then options, right? If a bank has a positive duration gap, a dollar gap, positive dollar gap, the risk is interest rates going down. So you need to have a put option, go long put option on interest rates. So go short. Right. You need to go long call option on interest rates. Sorry, long call option, because long call option is like receiving a fixed rate, and you're running a positive duration dollar gap. Sorry, positive dollar gap. Buying interest rate call option can be used to protect from falling interest rates. Remember, buying interest rate call options can be, sorry, interest rate futures can be hedged. We covered that. Options on dollar gap. Buying interest rate call option can be used to protect against falling interest rates. So you go long call option means you're like receiving a fixed rate, and if interest rates are expected to drop, then you benefit. So bank has a positive dollar gap. When interest rate falls, net interest income will reduce. This can be offset by gains from the call option, right? So call option on interest rate is like receiving a fixed rate. When interest rates drop, you will benefit. Buying interest rate put options can use against rising interest rates. Bank has negative dollar gap. When interest rates rise, net interest income will fall, but this will be offset by gains from the put option. Then interest rate swap. If a bank has a liability sensitive position, if they're liability sensitive, their risk is interest rates going up. Right? So that will be offset if they are paying floating, receiving fixed. Right. Bank has liability sensitive position. Liability sensitive, they will lose if interest rates go up. If interest rates go up, they will lose. Right? So they need to receive a floating rate and pay a fixed rate. If a bank has asset sensitive position, if it's asset sensitive, that means the risk is rates going down. Right? If that is the case, they need to receive a fixed rate, pay a floating rate. Right. Now, to summarize all of that, the easiest way to remember is receiving fixed, call option on interest rates, long interest rate futures. These mean the same thing. Likewise, paying fixed. Long put on interest rates. And short interest rate futures. These mean the same thing, right? So this and this mean the same thing. Right? This is the easiest way to remember it. This is long, let's say long interest rate or treasury futures. This is short interest rate or treasury futures. Okay, so we are not going into great detail. At your level, this would suffice. But that's it in terms of syllabus. Right. So everything is covered. I hope everything is clear. Now, the next thing is you all need to start doing questions. As many questions as possible. And we might meet at revision classes. So all the best, stay safe, all the best with your studies. Your exam is due next month. Good luck.